Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Great to be diving into these sources with you. We've got a stack here from MarketWatch, CNBC, Yahoo Finance, Reuters, Bloomberg. Quite a mix.
Absolutely. And our mission, as always, is to unpack what these reports are telling us, cut through some of the noise, and really get to grips with what's driving the markets and key companies right now.
It's all about extracting those essential insights for your perspective, the learner, right? Seeing how these pieces fit together.
Exactly. We've got everything from big tech stocks, global tariffs, central bank thinking.
And even some non-market business news that's, well, pretty interesting in its own right. And you start to see the connections pretty quickly.
Okay, let's jump right in then. Starting with the overall market picture from these sources. Last Friday, things were looking a bit down.
Yeah, the major U.S. indices, S&P 500, NASDAQ, DJIA, they all declined.
And a big theme popping up across these articles, sort of tying into that dip, is tariffs. Again,
Yes, definitely. Several sources mention President Trump's threats resurfacing, specifically a potential 25% tariff on iPhones made overseas but sold here.
and a bigger one, 50% threatened on EU imports.
Right. But what's interesting, and you see this noted in analyses from CNBC and Reuters, is that while U.S. stocks did drop on Friday.
The reaction wasn't maybe as dramatic as past tariff talk.
Exactly. Some analysts, quoted by CNBC, suggested investors might be starting to take these pronouncements, quote, with a pinch of salt.
A pinch of salt. That really says something, doesn't it? Maybe some skepticism or just getting used to the rhetoric.
Could be, given that, past threats haven't always materialized exactly as announced or they get walked back.
Well, speaking of walking back, or at least delaying,
Yeah.
there was that development over the weekend. Reuters and Bloomberg highlighted it.
President Trump announced Sunday he'd push back those 50% EU tariffs. The deadline's now July 9th, not June 1st.
Apparently after a call with the European Commission president.
And that delay, it had a pretty immediate effect on Monday's global trading.
How so?
Well, European shares traded higher. You saw the German DAX, the French CAC 40, both up, linked directly to that postponement.
And Bloomberg pointed out European auto stocks especially rebounded. They're always sensitive to this stuff.
Hugely sensitive. Vehicles are a massive EU export to the U.S., so German automakers got a lift.
Okay, and Asia. Reuters said it was mixed on Monday.
Yeah, gains in South Korea and Japan, but Hong Kong and mainland China saw losses.
And we should definitely note, as MarketWatch pointed out, U.S. markets were closed Monday for Memorial Day.
Crucial context. So we haven't seen the U.S. reaction to that EU tariff delay yet in the equity markets, but Europe and Asia give us a pretty good hint.
Okay, let's zero in a bit. Apple. MarketWatch had a piece using FactSet data that really highlighted some pressure there.
Yeah, they called out Apple as like the only stock in the Magnificent Seven that's actually down so far in May, about 8%.
And year to date, it's the worst performer of that group, down 22%. Ouch.
Significant, yeah. And that Friday tariff threat on iPhones we mentioned, MarketWatch noted it contributed to a 3% drop, making it 8 straight days of losses for Apple stock.
Wow, 8 days. So tariffs clearly hurting sentiment there.
Seems like it. But here's where that MarketWatch piece gets, well, more nuanced. Despite the stock dropping and all the tariff talk, some analysts they quoted aren't really blinking.
Really? After 8 down days and tariff threats, who are they and what's their thinking? What are they seeing?
Well, one is Gil Luria, head of tech research at D.A. Davidson. He basically thinks investors are missing the big picture.
The big picture being?
His argument is Apple still has a fundamentally healthy business, and it's all built on that sticky ecosystem. Once you're in with an iPhone or a MacBook, it's genuinely hard to switch out.
Right, it's the whole package, not just one device. The services, the integration.
Exactly. Luria points to the robust array of services offerings, too. He actually feels the recent stock weakness is less about the business itself and maybe more about, as he put it, the relationship issue between Trump and Apple chief executive Tim Cook.
So a personality clash driving the stock more than fundamentals? That's quite a take.
It's Luria's view, yeah. He suggests the tone of Trump's posts implies negotiations aren't smooth, but it doesn't make him change his basic outlook on Apple's business strength.
But, I mean, a 25% tariff, that would bite into profits, wouldn't it?
Luria addresses that. He thinks Apple could manage it, maybe raise prices a bit, pass some costs to suppliers.
Spread the pain around.
Sort of. And crucially, as he and others point out, Apple wouldn't be alone. Competitors like Samsung, making phones overseas too, would likely face similar tariffs, so it kind of levels the field.
Okay. And there was another analyst, Angelo Zeno at CFRA, also quoted in MarketWatch.
Yeah, similar idea. Called the tariff threat noise, said it doesn't impact his view. He even joked the main takeaway might just be that Tim Cook's relationship with Trump isn't what it was back when Cook got some tariff exemptions.
Okay, so we've got the don't worry strong ecosystem tariff noise camp. But the stock is down 22% year to date. Are there other concerns mentioned in these sources? Feels like maybe something else is going on too.
That's a fair question. And yes, the sources do raise other, maybe deeper concerns. Ted Mortensen at Baird, cited in that same MarketWatch article, points to AI.
AI, what's the issue there?
Mortensen says Apple's bigger problem might be Siri's integration with Apple Intelligence falling behind the competition.
Falling behind in generative AI, that
Yeah.
feels like a really critical point right now.
Absolutely. He warns Apple risks losing market share to rivals releasing, quote, life-changing generative AI services. And because of that risk, he suggests investors shouldn't be overweight Apple right now.
And he thinks Alphabet might be a better bet.
Yeah, based on its valuation and sales growth outlook compared to Apple.
Let's look at those numbers the article gave. Apple's forward PE around 26.
Right, which is below peers like Tesla, Amazon, Microsoft, Nvidia, but still quite a bit higher than the overall S&P 500's PE of about 21.
And the growth. The article mentioned Apple's estimated 2-year sales CAGR through 2026 is projected at just 5.1%.
Which is the slowest among those big tech names mentioned. The S&P 500 overall is projected slightly higher at 5.6%, and the IT sector within the S&P is way higher, over 11%.
So even setting tariffs aside, there are these questions about Apple's growth path relative to peers, especially if they're seen as maybe lagging in AI.
Exactly. And that brings us to the next big thing for Apple. WWDC, their Worldwide Developers Conference, coming up June 9th.
That's their chance to show off Apple Intelligence updates, right? Try to impress everyone.
Precisely. Gil Luria even suggested investors should basically hold off judgment until after that conference.
So the overall takeaway on Apple from these sources seems to be, yes, it's still a solid company, great ecosystem.
But the AI competition is real, and the external noise like tariffs adds pressure. Investors probably need to look closely at how they execute on the core business and, crucially, on AI.
Makes sense. It's about both the external environment and their internal innovation.
You got it.
Okay, picking right up on that AI theme, let's dive into NVIDIA. Sources like Yahoo Finance and CNBC keep highlighting it as, well, central to the whole AI race.
Yeah, the sources make it really clear. NVIDIA's meteoric rise is fundamentally fueled by massive spending from big tech on its AI chips.
Yahoo Finance noted Microsoft is their biggest customer by revenue, followed by Meta, Amazon, Google.
Yep. Tesla's a customer too, but much smaller, like 15th largest apparently.
It's amazing how concentrated that seems.
Yeah.
Yahoo Finance mentioned Meta spends, what, 25% of its capital budget on NVIDIA? And that accounts for over 9% of NVIDIA's total revenue.
That's right. And Gil Luria, the analyst we heard from on Apple, he's quoted here too. He believes NVIDIA relies on just a handful of these huge tech companies for about half their revenue. That's quite a dependency.
And it's not always direct spending, is it? CNBC pointed out Microsoft rents data center space from CoreWeave.
And then CoreWeave spends billions on NVIDIA chips. Microsoft apparently made up something like 72% of CoreWeave's recent revenue. It's this whole ecosystem feeding NVIDIA.
Cumulatively, these big players, Meta, Microsoft, Amazon, Google, they're set to spend over $330 billion this year, driven by AI.
That's the projection. Microsoft's talking $80 billion just for AI data centers. Meta raised its spending outlook for 2025. I mean, this is the wave NVIDIA is riding.
There's always a but, isn't there? Despite this incredible spending surge, sources point out challenges ahead for NVIDIA too.
For sure. One big one mentioned across the board is that very reliance on a few giant customers.
Because those customers are starting to build their own chips.
Exactly. These hyperscalers are increasingly developing custom AI silicon tailored for their specific needs. That could potentially lessen their reliance on NVIDIA's general-purpose chips down the road.
So, the hand that feeds might start making its own food.
Kind of, yeah. That's a risk analysts are definitely watching. Another worry is just, will this level of spending continue indefinitely? If big tech struggles to actually make money from all these AI investments, generate a good ROI,
they might tap the brakes on hardware spending.
it's a possibility. Plus, you have the whole geopolitics angle again. Trade policies hit NVIDIA hard.
Right. Trump's earlier trade war, the current U.S. ban on exporting NVIDIA's top chips to China, That's been a major factor.
Huge. NVIDIA CEO Jensen Huang, he actually called those curbs a failure.
Yeah.
Said they cost NVIDIA $15 billion in sales and hurt U.S. business more than China, in his view. And meanwhile, you've got Chinese competitors like Huawei stepping up in their home market.
But on the flip side, some recent news helped the stock. Sources mentioned a temporary U.S.-China trade truce and rolling back some other chip restrictions.
Yeah, those developments apparently gave NVIDIA shares a recent boost, just showing how sensitive that stock is to trade news.
Okay, so looking ahead, the big event is their earnings report, Wednesday, May 28th.
Right. First quarter results. Analysts expect strong numbers, revenue up maybe over 66%, EPS up 44%, very strong.
But Yahoo Finance noted that growth, while huge, is actually expected to slow down compared to the truly astronomical rates they've posted recently.
Yeah, the deceleration is key. Guidance will be everything. Interestingly, options traders, according to Reuters, are pricing in about a 7.4% swing, plus or minus, after earnings. That's actually less volatile than after some previous reports.
And Yahoo Finance had that historical tidbit. Buying NVIDIA before earnings and holding for a year has paid off well over the last decade.
A nearly 120% median return over 10 years, yeah. Just a reminder of the long-term trend, despite the quarterly bumps.
Okay, let's pull back again. Look at the wider global picture, trade, fiscal policy.
Yeah.
Drawing from Reuters, Bloomberg, MarketWatch here.
We mentioned South Korea's Kospi surging Monday on that EU tariff delay news. Japan's Nikkei also up.
But China and Hong Kong markets were down Monday. Hong Kong's Hang Seng fell over 1%.
Yeah. Tech and consumer stocks led the losses there, and Bloomberg specifically called out Chinese EV makers BYD and Geely among the worst performers on the Hang Seng that day.
Speaking of BYD, big news there. Bloomberg reported its shares tanked, down over 9% Monday in Hong Kong. Why?
They announced massive price cuts in China on 22 different EV and plug-in hybrid models. Some cuts were huge, up to 34%.
Wow, that sounds like they're really cranking up the heat in the price war over there.
Absolutely. It's already fierce. EV sales growth is slowing. Inventories are high. Analysts told Bloomberg this is a strong signal of how tough the end market is.
And they expect competitors to follow suit, squeezing margins even more.
That's the expectation. It puts pressure on everyone. Though sources like Bloomberg do note BYD has some advantages.
Like making their own batteries and stuff.
Exactly. Their vertical integration helps buffer the impact because they control more of their costs. And hey, despite the cuts, their Q1 profit actually beat Tesla's. And they recently overtook Tesla in European EV sales, too. They're a powerhouse.
Circling back to those U.S. chip curbs on China for a second, CNBC had a piece on how Chinese tech firms like Tencent and Baidu are dealing with it.
Yeah, they're adapting. Stockpiling chips when they can, making their AI software more efficient to run on less powerful hardware, using smaller models, and importantly, leaning more on homegrown Chinese chips.
And they talk about their full-stack AI capabilities. What does that mean here?
Basically, they control the whole chain from the AI research and software platforms right down to increasingly the chips themselves. They argue this gives them an edge even without the absolute latest U.S. hardware. Experts still say China lags in advanced chips, but they are building their domestic industry.
Okay, shifting back to U.S. trade policy again. MarketWatch and CNBC mentioned President Trump clearing that U.S. Steel and Nippon Steel merger.
Right, the $14.9 billion deal Biden had opposed. Trump posted on Truth Social, cited by CNBC, saying he thought it would create 70,000 jobs, add $14 billion to the economy.
And U.S. Steel stock jumped on that news.
Big time, up over 21% last Friday.
Okay, beyond trade. U.S. fiscal policy is also making waves, especially in the bond market. MarketWatch went into detail here.
Yeah, rising bond yields are definitely a worry for stock investors. Affects valuations, borrowing costs.
The 30-year Treasury yield hit levels near its highs from last October, and the 10-year yield popped above 4.6%.
Yep. Before pulling back a bit, MarketWatch connects this rise partly to nervousness about Trump's tax bill that passed the House, the perception it could add significantly to the deficit.
And this comes right after Moody's stripped the U.S. of its last AAA rating, citing deficit concerns.
Right. Plus, a weak 20-year bond auction didn't help sentiment either.
Analysts like Giuseppe Siza were quoted warning about deficits and the bond market vigilantes returning. What does that mean exactly?
It's basically investors getting nervous about government debt levels. If they start selling bonds because they're worried about deficits, it pushes bond prices down and forces interest rates, the yields, higher. That can ripple through the whole economy.
A kind of self-fulfilling prophecy of worry.
Sort of. Though not everyone sees it that way. Keith McCullough at Hedgeye, he argued rising yields and a strong dollar actually signal growing economic activity and inflation, not a recession. He pointed to healthy, high-yield debt markets.
But others are watching those levels closely. Larry Adam at Raymond James said a 10-year yield over 4.5% historically starts to trouble stock sentiment, and 4.75% would be even more concerning.
And MarketWatch noted this isn't just a U.S. issue. You're seeing rising long-term yields in Japan, too. This duration risk, the risk higher rates hurt long-term bond values, seems to be global.
This all creates a tricky backdrop for central banks, right? Reuters mentioned they're meeting in Tokyo this week.
Yeah, the theme is literally new challenges for monetary policy. How do you handle sluggish growth and sticky inflation if you can't really cut rates yet?
And Reuters specifically flagged Trump's erratic trade policy and tariff risks as making that job even harder for them.
An ECB board member was even quoted calling for a pause on rate cuts, partly because tariffs could actually boost inflation by making imports pricier.
And the Bank of Japan. They already cut growth forecasts because of U.S. tariffs.
Yes, and signaled a pause on rate hikes, even though their core inflation hit 3.5% in April. The governor said they're ready to hike again if inflation stays on track, though.
One last fascinating point from that Reuters piece on central banks. How businesses are using AI to cope with all this tariff chaos.
Yeah, wasn't that interesting? Tech firms using AI to map out complex global supply chains, figure out tariff impacts in real time, deal with changing customs rules instantly.
Sounds like AI is almost becoming a necessity just to navigate the uncertainty.
That's what one expert implied, calling the tariff uncertainty AI's moment to shine, a tool to manage volatility.
Okay, let's shift to a few other notable business stories from the sources this week, stepping away from the core market stuff for a second.
Right, there was that big tech story from CNBC about Jony Ive, the legendary former Apple design chief Steve Jobs' spiritual partner.
He's joined OpenAI.
And OpenAI is buying his AI device startup, Io, a huge $6.4 billion deal, reportedly. OpenAI CEO Sam Altman called Ive the greatest designer in the world.
Wow. That definitely signals OpenAI wants to build consumer hardware, doesn't it?
Absolutely. The vision, according to the reporting, is to work with Ive on creating maybe a less socially disruptive computing experience than the iPhone, something using AI that helps people look at screens less.
That's quite a turn from the iPhone legacy I've helped create.
It really is. One analyst even speculated about maybe a neck-worn device with no screen by 2027. Tapping Ive's design genius for a totally new kind of AI interaction seems to be the goal.
Interesting. Okay, what else? Social media news.
Elon Musk's X platform had another outage Saturday. Tens of thousands of users affected, CNBC reported. Second one in less than a week.
Yikes. What did Musk say?
He posted about a failure in their backup systems, failover redundancy, and said they need major operational improvements. Also mentioned needing to be super focused on Tesla and SpaceX right now because of critical tech rollouts.
Okay. And finally, a big one from the investing world, Warren Buffett.
Yeah, highlighted by CNBC. He's stepping down as Berkshire Hathaway CEO at year-end. He's 94.
But not completely retiring, right? The sources said he still plans to go into the office.
That's right. Still wants to contribute investment ideas, be involved in big decisions. He apparently compared his energy to his successor, Greg Abel's. Felt Abel was more effective day-to-day now.
But Buffett thinks his own special skill remains.
Yeah, his ability to stay rational and make smart calls during market panics. He said age doesn't affect his lack of fear when prices drop, which, sounds about right for him.
And the sources noted this fits a wider trend of people working past 75, like Bill Gates, Jim Sinegal, staying involved.
Seems like it's about passion for the work, not just needing the job.
Okay, we have definitely covered a lot of ground today, from that complex dance between tariffs and markets
to the pressures on Apple and NVIDIA, the whole AI race, the EV price wars in China,
U.S. fiscal policy worries, central bank dilemmas, and even big moves at OpenAI, X, and Berkshire Hathaway.
It really underscores how interconnected everything is. Trade, tech, policy, corporate strategy, it all weaves together.
Looking back at all these headlines and analyses you sent over, what's the one thread or connection that really stands out to you personally from this week's reading? How does it all shape your view of where things stand?
And maybe here's a thought to leave you with. With AI advancing so rapidly, alongside all this geopolitical and fiscal uncertainty we've talked about, how might the fundamental ways we interact with technology, and even the core ways we think about making investment decisions, need to change, maybe quite soon? All of these insights, of course, came straight from that stack of financial magazine headlines you provided us with.
That's definitely something to chew on. We'll be back tomorrow morning with fresh headlines from major financial magazines.
See you then.